connected in.
Oh, there's the camera. Did you see that? Where's the? Just something that makes a difference. Liv, yeah, you let the lady in. I'm not sure who she is. Yes, of course. I've left my class now. Sorry, Liv, I should have said please. I missed the dance group. No, I was just doing my rehab. I'm feeling like an idiot, but how are you? If I don't do it, I just won't do it. It's in my diary and I just... It makes a difference.
What did you do?
I didn't snap it. I heard it when I was 12.
Oh,
And this is the first physio, and I'd love to get back to playing tennis.
Yeah.
This is the first physio who said to me, do you know what? We actually can, if you do these things. Yeah.
Everyone can hear us well.
Going to have good mobility, I suppose.
Yes, it's clear, Matt.
Thank you. Okay.
Of course, is the problem.
is anybody wanting to make a coffee order? Are you all good? Michelle, did you
No,
get the?
no.
Yes. Okay.
Has everyone ordered a coffee that wants one?
Thank you.
Get turned into that.
Alrighty. Welcome to 29th of August, Integrity PD Day, everyone in person and online. Looks like to be a very good lineup today. I'm going to throw over to Liv to give us a bit of an introduction to our first speaker. For the people that are in the room here, please scan the QR codes for checking in and then session feedback afterwards. Alrighty, throw over to you.
Thanks, Matt. Hi, everyone, and hi, everyone online. I know I've met a few of you before, but for those that I haven't, my name's Liv. I'm a BDM here at Pinnacle, based in Melbourne. I know a lot of you are familiar with Pinnacle as a business, but for those of you who aren't, we're Australia's leading multi-affiliate investment management group. So we have about 180 billion in funds under management across 18 affiliate fund managers. We provide all of the non-investment services to those fund managers to allow them to focus on what they do best, which is investing. And we really believe in alignment with those investment managers. You're probably familiar with a few of the names here, but today we've got very excited to have Anthony Doyle, our Chief Investment Strategist, here to give you a bit of a macro update, bit of a market update. We've got a presentation, but we're also sort of happy to take it wherever you'd like to as well. Feel free to jump in with questions at any time. I think we've got about 45 minutes for the first session and then some morning tea. So
yep,
I'll hand over to
10:30 stop, is that right?
10.
Because I could go for 3 hours. Just want to make sure we've got the clock here, which is very good. Yes, by way of introduction, my name's Anthony. I joined Pinnacle 2 days before Liberation Day. So fortunately, I'd worked with Liv for around about 3 years, as previously I was at one of Pinnacle's affiliated managers, Firetrail. But I have a background in macroeconomics. I worked in London for 10 years in global fixed income and currencies. I worked in multi-asset at one of the world's largest investment managers, Fidelity, where I built institutional solutions, sovereign wealth funds. And so it was very easy to join Pinnacle because, as Liv mentioned, we've got the full breadth of affiliated managers across all asset classes. And I knew the caliber of the affiliates as well. But certainly there's been a lot to talk about. I've written a lot. I've seen a lot of clients. And one of the first things I actually did when I joined Pinnacle was I wrote a white paper, which was published just before Anzac Day, on why I was bullish equities, and sent this white paper out to around 15,000 advisors. And the first email I got back was a bit of hate mail. So I can't believe a chief investment strategist has written this. Take me off your distribution list. This is irresponsible. So, oh my God, I'm not sure I'll pass probation here. This is the sort of feedback I'm going to get. But basically, I kept the email. I keep mentioning to our CEO, Ian McCowan, can I reply back to this guy? He said, no, take the high road. And the reason is, in terms of the content of the white paper, I was quite bullish on equities, and I still am today, as you can tell with the title of the presentation. And so I'll step through some of the macro tailwinds that I believe that risk assets more generally, growth assets more generally are experiencing, and then highlight, some of the speed bumps that we can foresee in the road ahead. Now, we sometimes get caught up in what the US Federal Reserve is doing with interest rates and what Donald Trump is tweeting around Jay Powell and putting pressure on governors to resign or sacking them, and they're coming back saying, I'm not going to go. But and we also obviously focus highly on what the RBA is doing. So they didn't move interest rates in July, then they did move in August. And then we saw a more hawkish or a higher inflation print this week as well, suggesting that the RBA probably won't move interest rates next month, which is what the bond market had been expecting, and that's been pushed out to November now. But we sometimes forget that global central banks are in a synchronized easing cycle. Now, whether I'm talking about the ECB, the Bank of England, the Bank of Canada, the Swiss National Bank, the RBNZ, all are very much well along the way in terms of reducing interest rates. And this is a wall of monetary stimulus that's hitting equity markets and growth markets. Essentially, what you see is that when interest rates are reduced, investors move out the risk spectrum in order to generate returns that will compensate them for higher inflation. And that's exactly what we're seeing. So when you talk to your clients and say term deposit rates are falling because the RBA is cutting interest rates, because inflation is low, they're going to say, what the hell are you talking about? When I think about what I spend money on monthly, utilities, insurance, healthcare, food, energy, these prices are rising materially above inflation. So the thing to remember is that the CPI, what central banks target, is not an individual's cost of living. An individual's cost of living is very different to the overall price level of goods and services within an economy. And you have to think, what are those non-discretionary items I spend money on month in, month out? Like I live Collingwood membership tickets. On what rate are they increasing rates or reducing them? I'm not sure. If you're a Carlton fan, they're cutting rates. Memberships. So deflation in Carlton tickets. But you have to think about where are you spending your household balance month in, month out. And in order to compensate for that higher costs, you have to take more risk and generate higher returns. So to give you an example, we have a manager in Brisbane, one of the best quality growth managers globally, named Hyperion, and they estimate for their global growth equity portfolio, a 1% decline in interest rates represents 20% in terms of multiple expansion, the type of companies they own. Companies that you all know, Amazon, Meta, Hermès, Costco, Microsoft, for example, very defensive quality growth style names that are growing earnings north of 20% per annum. So as I mentioned, what we're seeing in terms of the global economy is financial conditions are very loose. So it's a measure of how easy credit is come by for corporations, households, businesses, consumers. And so this excess liquidity in the market is finding its way into risk assets. And it's my belief that when you see these tailwinds persist, you should lean into them. So as advisors, you all build diversified portfolios for your clients. Whatever your long-term neutral weight is to equities, I would suggest you should be at least that weight, if not overweight, at the current point in the cycle. Now, as I mentioned earlier, the inflation rate is not an individual's cost of living or your client's cost of living. Everyone's cost of living is different. But what the bond market is saying for inflation, despite all the noise you're seeing in the media around tariffs and a weaker dollar, cost of living pressures, when I look at what billions of dollars are suggesting will happen in terms of inflation, what break-even rates are the difference between the yield on an inflation-linked bond and a nominal bond? And that's the inflation premium. And what the bond market is saying is that inflation in Australia over the next 10 years will average around 2.25%. So near the bottom of the RBA's 2 to 3% target band. In the US, it's around 2.4%, even with potential tariff pass-through. And in Europe, using Germany as a measure, it's 1.75%. So this is enabling central banks to reduce interest rates to support labour markets. And that's why unemployment rates remain around 50-year lows. So lower rates plus lower inflation, higher risk appetite and higher equity multiples. That's why, despite all the media you see, equity markets have generally been on a one-way street higher since the sell-off that we experienced post-Liberation Day. Now, we have some tailwinds there in lower rates, lower inflation outcomes, giving central banks headroom to reduce interest rates to support labour markets and their economies. The other big tailwind is fiscal spending. So fiscal spending hasn't really reduced since COVID. Whether I'm talking about the federal government with infrastructure spending and tax cuts coming through, whether I'm talking about state governments with spending on infrastructure and healthcare services, whether I'm talking about the US with the One Big Beautiful Bill, which is essentially a Keynesian stimulus package into the US economy. Europe, in terms of Germany, is expanding to the greatest extent that it has done outside of recession. And other European NATO members are now expanding spending on defence to reach 2% of GDP in terms of their NATO obligations, increasing to 5% potentially by the end of the decade. So governments around the world are very much spending and have their fiscal foot on the accelerator. In Australia, this is why we've seen private sector employees being laid off, but the public sector hoovering them up in sectors such as the NDIS, healthcare and infrastructure. The Queensland government are finding it hard to attract tradies to build the assets for the Olympic Games, the 2032 Olympic Games, for example. So this government spending is supporting stronger growth outcomes as well. And this is why labour markets are around 50-year lows in terms of the unemployment rate. This has shocked most economists. If I told you that 2021 interest rates were going to increase at the fastest pace that they had done since the 70s to address high inflation, well, I can tell you what economists predicted. There was a 100% likelihood of a recession in 2022, and it never eventuated. Because the fiscal side has been so strong, we didn't have the big labour market deterioration, the big shift up in unemployment. This is important because when you look at GDP, around 2/3 of GDP is consumption, around 2/3 of GDP. Now, notwithstanding that Australian households tighten their balance sheets as mortgage rates increased, we're now seeing that the reduction in rates that we've seen, a couple of rate cuts, is supporting higher spending. The CBA updated us on this in their annual results a couple of weeks ago, that we're now seeing all age cohorts of the Australian economy increase their spending, whereas previously it was just boomers and older demographics, and it was very much younger generations that were tightening belts and actually constraining spending. Now actually all age cohorts are spending again. So I don't anticipate a big deterioration.
Sorry, just a question on that fiscal spending. Is there going to be a point in time where that's just going to cap out, or is it, spoken about like debt ceilings and stuff like that? Have you done any research or, personally or whoever, as to there's got to be a point in time where how much is too much?
Yeah.
At the end of the day, does that, devalue our dollar, US dollar, over time?
Yeah, I mean, at the vanguard of debt is Japan. So the Bank of Japan now owns over half the Japanese government bond market. So they have a debt to GDP of around 225%. US is around 110. We're about 50 in terms of public debt. Now we have very low, by international standards, very low public debt to GDP levels, but very high private debt to GDP levels. So when you look at public and private debt, we're actually very, very high because of our exposure to the housing market. That's why we're so levered into the housing market. So the question mark is today for the bond market in particular, the short end of the yield curve is being dominated by Trump wants lower interest rates. He's going to get them come hell or high water. Jay Powell is actually, his term as chair is up in May. And so he'll be replaced by a very dovish chair who is going to engineer those lower rates. So you've seen the short end of the yield curve collapse, but the long end of the yield curve is more concerned around inflation, a weaker dollar, and debt sustainability concern. Now, in my view, what happens is if you see any concerns around financial stability because of a disorderly sell-off in the bond market, central bank will step in and buy the debt. We saw it with the Bank of England during the emergency budget when sterling collapsed 20%. We saw it during the Silicon Valley Bank concerns and Credit Suisse was acquired by UBS. Central banks expand their balance sheets in order to address financial stability, and they use interest rates to manage inflation. So the long end of the curve, what we're seeing is higher volatility in yields there, but the short end of the curve, volatility is shorter. So that's why, and I'll mention this later, I think complementing some interest rate duration in your defensive buckets with floating rate note exposure is the best way to manage those risks, particularly around debt sustainability concerns where you might get a bond market tantrum. So the good news is really I'm bullish, and I'm not sure, I've done over 100 meetings the last 2 months and people say that I'm out on the edge of consensus again. But given those tailwinds, I wouldn't want to be short the equity market here. Now, that's notwithstanding, there will be cycles of volatility. Typically, uncertainty manifests itself in volatility, and I do expect volatility cycles to be more compressed, particularly given who's in the White House at the moment and how volatile he can be.
Mhm.
But what I wanted to highlight to you was when we look at markets at a broad level, yes, they are fully valued in terms of PEs, but PEs are reflecting the larger weight that technology is within the S&P 500 and the MSCI World Index. And the good thing about tech as a sector is generally they grow earnings at a far higher rate than a traditional industrial that is more aligned with the traditional business cycle. If you're an automobile manufacturer, for example, there's only so much in terms of pulling the price lever consumers are willing to accept. Whereas for those of you that have Spotify, you might have got the email last week, they're increasing their prices again. So tech firms generally are capital light. They have relatively few employees, relatively low capital expenditure. And so that allows them to generate higher earnings growth, north of 20% per annum in the case of Spotify. Now, the good news is when you look at the stock market as a whole, all the earnings growth, really, the US will dominate. You can see EM is of a similar level. But for those that are saying that US exceptionalism is finished, don't believe it. Don't believe it. You want to have a healthy weight towards the US. Now, looking at the median company, so moving beyond those mega caps, earnings growth expectations are improving for the median company. And this is what we're seeing in the market over the last 6 months. Dispersion is widening, intra-market correlations are falling, and we're seeing those gains broaden out. So for Australia, for example, small caps have outperformed large caps over the course of this year. In the US, small caps for the first time are beginning to appreciate relative to large caps as well. So this US earnings advantage, it is being dominated or it is being driven by those mega caps, but don't discount the ability of small caps to generate good returns for you going forward as well.
And then does this factor in Trump's tariffs and the full implication of that? So are you suggesting basically the company's just going to pass on those tariff increases?
So this is 12-month forward expectations as of last week. So the best assumptions that the sell side of analysts can make for tariffs. If anyone tells you they know what the ramifications of tariffs are on a company's balance sheet, they're telling you porcupines. No one really knows to what extent tariffs can be passed through. I can tell you for a company like Hermé, in terms of Birkins, they attract a 15% higher tariff. They're just going to pass that right on. Because think of who their customers are, and they're getting tax cuts on the other side from the one big beautiful bill as well. When it comes to a company that's importing toothbrushes that are manufactured from China and have a 30% higher tariff, whether they can pass that cost on or whether you'll see consumers have a substitution effect remains to be seen. The big question for me now is, in terms of, let's just focus on the Magnificent Seven. You have bifurcation within the Magnificent Seven performance versus Amazon, Meta, Microsoft, Nvidia against quality traps that are emerging, like Apple, which has a 30% higher tariff because iPhones are manufactured in China. Whether they can pass that cost on to the end consumer remains to be seen. In a world where China is increasingly competing in high value added items like TVs, phones, electric vehicles. So whether Apple can continue to innovate and build the category killers like an iPhone or an iPad or an iWatch in a world where competition is increasing and costs are increasing, I'd be skeptical that if we increased iPhone prices today down on Collins Street, you'd pay 30% higher versus some of the other phones that are available, like the Samsungs. And then on the other side, Alphabet is also a quality trap potentially that's emerging because of the rise of ChatGPT. So studies have shown that once an individual starts using ChatGPT, they return to Google 92% less within 12 months. So what does that mean for their ability to sell advertising going forward and search engine optimization? Alphabet are now trying to disrupt themselves. And that's why when you go on Google, you see an AI summary Gemini, because they don't want ChatGPT to disrupt them. They're trying to disrupt themselves. So these are some of the questions that exist out there. And I'm seeing quality traps, growth traps, value traps. It's why you have to be forward looking. And I wrote a piece yesterday that Liv can send to you on backward looking smart beta strategies, indices. This is a world where post QE, post GFC, the tide lifted all boats. Going forward, where there is a risk-free rate of around 3%, a cost of capital, there are countries, there are sectors, there are companies within sectors that will perform better than others. And that's something that active managers with a forward-looking assessment really have to take that view. So I think what's interesting, as I mentioned, we've seen quite a structural shift in the drivers of performance in equity markets. It's why in our affiliate range, I have a Hyperion Global Growth Fund with a quality growth focus outperforming, and I have Antipodes Global Value Fund with a value focus outperforming the benchmark. It's quite unusual to see those factors working as one. And the reason is not only being forward-looking, being active, but it's been a regional call this year. So what these charts highlight is growth versus value in the US. So that declining line shows that growth has outperformed value type stocks in the US market. But if you look at the European market, value has outperformed growth over the last 12 months. And so whilst I like quality growth as a factor and as a manager in terms of Hyperion, I believe you want to build in some of that value exposure into your clients' portfolios as well, because value holds up during periods of turmoil. Typically, quality growth are long duration cash flows where discount rates matter. So as I mentioned, a 1% decline in rates represents 20% in multiple expansion. But when volatility hits, the market becomes hyper-focused on defense, balance sheet strength, and visibility of cash flow, looking at dividend yields, earnings yields, typically value style companies, utilities, infrastructure, real estate. And so with that in mind, you want to build a portfolio of global equities that has a good core, some of that quality growth exposure, some of that value exposure, in order to protect on the downside when volatility strikes. And then when markets inevitably recover, you're appreciating from a higher point. All right. So this next slide, as I mentioned, I wanted to highlight to you some of the traps that are emerging from household names that you all know. So on the value side, Intel has drawn the ire of Donald Trump, but these are all stocks since 2021 that have derated between 60 and 45%. So Intel on the value side, Nestle on the quality side, Louis Vuitton on the growth side. Louis Vuitton down 40% this year. And, you know, one of the problems that Australian investors and advisors that I talk to, you know, many have used, for instance, Qual as a core exposure within their global equities. Quality has underperformed the MSCI World Index by about 10% over the course of the last year because it has a high sector exposure to tech. The second highest sector is healthcare, and healthcare has totally derated. So be aware that past metrics that screen in these companies into the indices. So Intel is the third largest weight in the value index. Nestle is a top 20 and Louis Vuitton is a top 10 in the respective indices. These backward-looking indices, they screen in companies based on historical metrics, and they're not forward-looking enough to avoid these pitfalls of deratings that can occur. So be wary of these funds. I wouldn't hold them as a core, but they could potentially complement on a satellite. Better yet, an active approach given where we are in the cycle. Now, I'm sure when you have client reviews for end of financial year, and when you talk about equity markets, or they might call you up because the ASX has just punched through 9,000 points. They're saying, is this a good time to invest? And investing at all-time highs, historically speaking, has been a great time to invest. So this is an analysis of the S&P 500 since 1968 until the end of last year. And what it shows is the average performance over discrete time periods of investing at an all-time high versus investing at other points in the cycle. So yes, equities, timing equities or timing any investment in an asset class is difficult to do. But what I would advocate is what most financial advisors do with their clients' portfolios is dollar cost average with a lump sum investment at the start. But typically, for example, if you invested at an all-time high, 5 years later, you've generated a 79, 70, or almost an 80% total return. At any other point, it was around 74%. I can also tell you that if you invested at any point since 1926 in the S&P 500 and held on to that investment for 5 years in the equity market, there's a 99% likelihood that you had a positive return. If you invested the day before the Lehman Brothers collapse, you invested in February of 2020, if you invested before Black Monday in 1987, hold on to that investment for 5 years in total return terms, 99% likelihood you had a positive return. It's even better for Aussie equities. So at the end of the day, as interesting as it is to try and work out what Donald Trump is doing and what's happening with trade in China and the US, it comes back to the hallmarks of modern portfolio theory, which is diversify and take a long-term view. That's really how you can assist your clients in meeting their long-term investment and savings goals.
You should send that slide to Alan Kohler.
Oh, is he bearish? Is he bearish?
Well, he keeps commenting about how we're at all-time highs and,
Well, guess
every time.
what follows all-time highs? More all-time highs.
The graph has to go up on some sort of reasoning, doesn't it?
I've seen so many clients that were waiting for the pullback and it never came. It just never came. And I'm sure you have that similar experience with your clients that think they can time the market. Now, when it comes to timing the market, it's not to withstand the risks that are out there in terms of tariffs, in terms of the Fed potentially becoming less independent, in terms of a stagflationary environment developing. But one thing I thought might be interesting for you, given it's the end of winter, is that beware the returning fund manager from the Greek islands. In terms of the Wall Street manager or the London manager, even Aussie-based managers. I was speaking to a colleague, Lucas said he was out in Greece, which I was surprised about. Even BDM's coming back from holidays. But the reason is they're on the beach and they're thinking about markets. And typically when they come back, they tinker with the portfolios. And so this is an analysis of monthly returns, monthly total returns for the ASX and the MSCI World Index. And you can see typically September are drawdown months on average. Now, given how much uncertainty there is at the moment and how many portfolio managers went to Europe during August, I wouldn't discount a sell-off in September. That said, I would expect it to be an opportunity to allocate, particularly as around the middle of the month, we'll likely experience a Fed rate cut. 88% probability priced into the market. So as I mentioned, there are risks. So appropriately diversifying is really the best strategy, particularly as post 2022 and 2023, a lot of advisors, a lot of private bankers have let their exposures run, whether that be tech over other sectors, whether that be growth over value, whether that be the US over Europe, whether that be DM over EM. It's appropriate to rebalance some of those portfolio exposures at this point in time. Sorry, this is it's the batteries. I just wanted to highlight, now we're moving into the fixed income space. I'm bullish on equities, but government bond curves remain steep. And as I mentioned earlier, I believe the best thing to do with the defensive allocation within your portfolio is to blend a duration exposure where you can harness the power of higher yields because government bond curves are steep and you get the carry and the roll down in the curve to take some duration exposure. So we have a manager called Coolabah. They're Australia's largest fixed income manager. They have strategies that have pegged duration to the index duration, which is around about 5 years, which is really the sweet spot in the government bond curve today. But blend that with some floating rate note exposure as well. So no interest rate duration, but don't give up the higher yields available or the higher income gross yield that you can achieve via some of these floating rate note strategies, like some of the offerings that Coolabah have. So blending that will enable you to manage the interest rate duration on the defensive portfolio. And interestingly, when you look at corporate bond spreads, investment grade credit spreads, so these are very low probability of default, bonds issued by large multinational companies like BHP and our banks, Microsoft, etc. Corporate bond spreads are back at 25-year tights. So what Coolabah are doing at the moment is moving up in credit quality bias, and I would have a similar view. So whilst Coolabah are generating income of around 7% with no duration, they have a high credit quality. So it's the same in government bond markets. If yield curves are very flat and I'm getting 4% on cash, why would I lend 10 years at the same rate? There's no term premium. Why would I lock up my money? It's the same for credit risk. Why should you lend to a triple B rated company if the spread isn't compensating you over a higher quality company? So I would favour higher credit quality allocations at this point as well. And low spreads generally reflect a benign outlook for the economy, which is what the equity market is saying as well. So the equity market and the credit market are aligned in their positive view of the world. Now, as I mentioned, when I look at volatility, equity market vol has absolutely collapsed, but the bond market is higher. So again, blending that duration makes sense. So in between analysing Donald Trump and looking at the state of the world, one of the first things I did at Pinnacle was build long-term strategic asset allocation. And what I did was build SAA for the typical risk profiles that you would place your clients into, from all growth to conservative. And I compared Pinnacle's strategic asset allocation versus a passive approach, which you would get from Vanguard via their diversified products. So they're managing over $30 billion across unit trusts, ETFs, SMAs, across these risk profiles. So I back tested the weights using index data versus Vanguard. And what I can show over the last 10 years is that having a weighting in this SAA versus a passive approach will add value, will add excess returns. Now, bear in mind, you've never seen a back test that doesn't work, right? So I can confirm that my back test is in there as well. It works. But where I would anticipate that you as advisors could add further value over this long-term SAA is having tactical positions around it, depending upon where we are in the cycle. So as I mentioned, floating rate note exposure over interest rate duration, EM over DM, small cap over large cap, value over growth, these sorts of positions that you could take. And then the real free kick is adding in the top performing active solution within these asset classes. So Vanguard, VanEck, Beta Shares, what they'll often tell you is that the average active manager underperforms the index, and that is true. But if you can hone in on that top decile or top quartile of managers, you can generate substantially higher excess returns than what you would experience via an index exposure. So what I did was looking at our 80 or so funds, sub in the portfolio, the fund within each core or satellite that had generated the highest excess return since inception with a minimum 3-year track record. So you can see here, I have good diversity across factors. I have good diversity across asset classes. But to give you an example, in small caps, we have 4 fund managers. All the portfolios have outperformed the small cap index. Now, this is simply looking at excess returns. I'm not accounting for volatility here. So if you're looking for a small caps manager that would outperform, have a higher Sharpe ratio, less volatility, we have a manager called Longwave, for example. Hyperion have an Australian small companies fund as well, focused on quality growth. So they're all good, but I just put in the fund that had generated the highest excess returns. In this case, it happens to be Firetrail. They've delivered around about 12% excess return over the Small Ords Index over the last 5 years. In terms of global, we've got Life Cycle in there, 7.5% excess returns over the MSCI World Index. Plato Global Alpha, 12.5% excess returns since September 21. Hyperion, 5.5% excess returns since 2014. Antipodes, with a value style approach, 2.5% excess returns over the MSCI World Index over the last decade. Now, Langdon, 6% excess returns in global small caps. We've got SMIDS at 13.5%. And then you'll be hearing from Julian on REITs and listed infrastructure from ResCap, exceptional outperformance as well. And even on the defensive side, whether you're looking at Coolabah or private credit biometrics, you can see excess returns again. And over a long period of time, 7 years, 10 years plus, this just allows you to harness the 8th wonder of the world, according to Einstein, compound interest. So you're compounding at a much higher rate. And to give you an example, the MSCI World Index was up 15.5% last financial year. Hyperion was up 45%. Plato Global Alpha was up 33%. And that SMIDS fund, Antipodes Global SMIDS, was up 38%. So we had 3 of the top 10 highest performing global equity funds in the Aussie market. And when I talk about active outperforming index exposure, of our funds that have a 5-year track record or more, 91% of those funds have outperformed the index, have outperformed the benchmark. So yes, Vanguard and Co will say the average active manager underperforms, but who wants to be average? So you can identify these managers. We believe our approach is the best because we ensure very strong alignment of outcome from the investment team to the end client. They're the majority owners in their business. We're always a minority shareholder. They're co-invested alongside the end client. It creates not only high level of incentive to outperform, but it retains investment talent. And all you've got in funds management is investment talent. It's not hard to start a fund management firm. You have a computer and an internet connection, and away you go. But Pinnacle undertake all the ancillary services. So I used to work at Firetrail, so I know what it's like on the other side. So Pinnacle do distribution, legal, compliance, HR, marketing, everything that essentially, if you're an investment team, you don't want to do. All you want to do as an investment team is pick stocks or work out what Donald Trump's doing. So is that the end of my session, 10:15?
Yeah. Do we have any?
Yeah, any questions?
Anything online?
Excellent. And thank you so much.
Cheers.
Shirley.
All right,
Thank you.
Thanks, Anthony.
all.
Particularly getting up at catching the 6 o'clock out of Sydney this morning.
Yes, no worries. Happy to
Very
do
well
it.
prosecuted.
Ah,
Yeah, thank you.
Yeah.
Well
Excellent.
done. I'll circulate the presentation after this.
Have a good day, everyone.
Thank you.
Thank you. And we'll have a break for morning tea now. So we'll join back online in 30 minutes or so. See you then.
A little bit of housekeeping. Apologies, I didn't mention at the start. Just bathrooms are